An interesting dividend stock for the long term, which has recently dropped quite a bit in price, is Portland General Electric. I'll show you some characteristics of this stock to explain why it's interesting for dividend investors. First of all, it's an energy company, not much exciting to report about it. What's perhaps more interesting is the valuation, which doesn't seem very cheap, but still cheap enough, maybe for long-term dividend investors. Morningstar gives it a 4-star rating with an economic moat that doesn't really stand out. So it's not a very broad economic competitive advantage, but at least according to them, it's a small competitive one. Advantage, of course, that has to do with all the assets and the distribution network they already have for electricity. What's more interesting is their intrinsic valuation, which comes out to $53, and the current price has comfortably dropped to $40. So here is possibly a bit of margin of safety, but of course we need to calculate the intrinsic value ourselves. Absolutely. To ask, the advantage is that these kinds of companies are easier to analyze, making it easier to determine their intrinsic value. Analysts indicate that their price target is $51. That's also higher than the current price. Perhaps that's more interesting. The latest estimate is $43. So the price has dropped below that for some reason. The entire stock market is currently declining, so that could mean an interesting entry point for certain stocks that are already undervalued and are just getting cheaper, or even undervalued. Portland General Electric might also be undervalued. A tool we can use for that is fast graphs. We see that the current price to earnings ratio has now dropped to just under 13. Let's zoom in a bit more, and then we'll see that the current price is below the fair value line, which is the orange line. So this is actually the first time in quite a while that it has been like this. For long-term investors, this could mean an interesting moment, especially because it pays a relatively high dividend. And that's, of course, also the case for this analysis. Now, the current price to earnings or forward price to earnings has dropped below 13. Actually, the normal multiple is around 20. That does stop at the slightly higher end later. Just to be safe, let's maintain a lower price to earnings ratio. Price Wentz ratio. Then we see the possible liquidity figures below, forecasted by 11 and 7 analysts. Yes, around 4.5% and 2.5%. Profit growth isn't really that much. So that all seems quite realistic. That would also imply a lower valuation. Let's say it's 14. Then the annual return could average around 11% for the coming years, with a total return of 70%. Keep in mind, this includes dividends. We're taking a slightly higher price to earnings ratio, and this is, of course, just a forecasting tool. Of course, reality could turn out to be disappointing, but then the return could actually be really attractively high on average, with even a 20% return, and the downside potential is always there. But it's, of course, just an established company with energy consumption from customers. It's an energy company. Yes, I believe energy will still be needed in the future. So you can think about it very difficult, but I think the current stock market is declining. I think this creates a buy moment, an opportunity to buy this stock. The valuation looks relatively good, at least because that's comparable to the sector median. But also, if we just look at the current figures, so the forward price to earnings for next year is set at around 13, not super cheap, but it's also not exactly too expensive. The payout ratio, that's obviously more important for the future. That's at 1.5. And ideally, we actually want a payout ratio below 1 or well below 1. So it's quite heavy in comparison. The sector or median is positive, but I wouldn't say it's super positive. The dividend yield is 4.8%. We'll take a closer look at that in just a moment. Well, what's attractive is the price to cash flow, which is relatively low. But be careful, this is a capital intensive company. So you'll want to look at the cash flow analysis here, for example, regarding what freedom is. Cash flow is that's operating cash flow minus capex or capital expenditures. That actually gives the free cash flow of the company. Very important. With this stock, before I start looking into General Electric, is the relatively high debt. The market value is 4.2 billion, but the total debt is 4.7 billion. So that's still quite on the high side. If you look at the price to sales, it's 1.2. So what you can do is always take the market value Turn the price to sales factor to 1.2, and then you know what the revenue is approximately. So in relation to the revenue, they have a lot of debt. So here you definitely need to take a good look at the balance sheet and the cash flow. What's exactly going on? Revenue growth, and especially the profit growth, have already been looked at for the earnings per share. Here we see some estimates, basic statistics for the EBIT growth, and regarding growth, it's relatively good compared to the sector. Actually, they only score on profitability. Compared to the sector, it's a bit less good, but the net income margin is still 10%. So a 10% profit margin isn't superior, but it's just fine. The mini sector is actually a bit higher, and this is compared to the electric utilities sector. So that's a good sector for them to be in. Compared, return on equity isn't special, but it's also not really a good stock. Overall, it scores relatively well on the factor analysis at the moment. Let's take a look at the dividend yields. Well, that's exceptionally high. The current dividend yield is 4.8%, especially because the current price has dropped quite a bit. The average over 4 years was around 3.8%, and for next year, a dividend of almost 5% is estimated. What's even more interesting is it has paid out dividends for 18 years in a row, and also 18 years in a row. Dividend growth. Well, that's certainly interesting. If you're a dividend investor looking to create more dividend on dividend, then Portland General Electric is a very interesting dividend stock, not just for dividends, but also for potential price appreciation. Stock, not just for dividends, but also for potential price appreciation, because the price has dropped significantly by about 16%. I've shown you the fair value estimate from Morningstar, which is around 53, and from analysts, it's around 51. Here you see the price was around 48 last September 2024, somewhat in line with 2023, but it has recently dropped by about 60% to a previous support level, you could say, based on technical analysis. As you know, I'm a long-term investor, but occasionally, here we are indeed looking at technical analysis to see if there is, for example, a support level. You could say you want to, but there are simply technical traders in our market, and they are already playing the game through me. So in the very short term, it's always useful to take a look at the technical charts. We've already noted that Portland General Electric seems relatively cheap in terms of its stock. Now you need to investigate what the future long-term growth potential of this company is. So mainly the competitive advantage. And if both of those factors are good, then the last thing is, of course, the right entry moment. We're actually looking at 2015, the same price level, and also the same price level in 2018. It only dropped further during the coronavirus crisis. So all in all, simply put, this could be an interesting entry point around $40. It seems that A&L is relatively cheap, or at least attractively undervalued. Not much margin of safety, for that A&L would need to drop further, and perhaps that's the case as well.